Hey traders, Jason from Levitt Brothers. So in this video, I'm going to go over what I consider to be the state of the market. We'll look at the indexes, we'll look at some breadth indicators, get a sense for what's going on the surface, beneath the surface. I do this every few weeks. I think it helps people out. All right, let's get to it. All right, here's S&P 500 weekly chart. It's a weekly chart, so it's not going to change much week to week. Relative to the last time I did a video like this. It's strong, it's healthy, it's trending up, everything is going well. You can see here it rides its 8 EMA up, then we get a dip to the 21. Now it's riding its 8 EMA up again. Big down week last week after early strength, and now this week so far we're bouncing. So far so good. The market's strong, it's healthy, it's trending up. Even if we break down here and come down and test the 21 over here, that'd be perfectly fine. It would not destroy the overall health and strength of the market. All right, so market's doing well. There's no other way to interpret this. You had a big rally up here, 2021, big cup and handle pattern, 22 into 23, and now a solid rally. Trend is up until it's not. As Peter Lynch says, more people lose. More money is lost anticipating like a pullback than in the pullback itself. And if you're drastically underinvested because you're waiting for a pullback, then you end up losing more money in opportunity costs than you do in an actual, 3, 4, 5% pullback. So market's doing well overall. It's been like that for a while. No reason to change our overall bias. NASDAQ looks pretty much identical, same rally here, same cup and handle pattern, same, riding the 8, test the 21, riding the 8. Everything looks good there. S&P, NASDAQ combined, they hold all the big important companies, and if those two indexes are trending up, there's probably something good going on in the market. Yes, it's been a stock picker's market. You can't just, a rising tide is not raising all ships. You can't just close your eyes and buy a bunch of stuff because there are pockets of weakness. There have been pockets of weakness. So you've had to be a pretty good stock picker. But certainly you've had a nice wind at your back because the important indexes are trending up. Here's a Russell 2000. So it has been mostly neutral for the last, what is this, 1, 2, 3, 4, 3.5 years or so. Traded in a big range over here in 21 while the rest of the market was trending up. Then when the market was, the NASDAQ and S&P were doing these big cup and handle patterns over here, this just traded in a range. Broke out to the upside. Now we got a range at a higher level. And just in the last couple of weeks, we got a breakout. 3 weeks ago, it closed above its range. Last week followed through a little bit, closed off its high. Now this week we're following through again. So everything looks good here overall. I'd say neutral overall because we're pretty much unchanged going back 3.5 or 4 years-ish. But in the near term, certainly things have shifted to the buy side, or to the upside, I should say, and I think it's inevitable that this high is going to be tested, whether it gets tested like right now or whether we have some softness as we head into the fall and then we go test it in the late fall, early winter months. I don't know, but this high is like almost guaranteed to get tested at some point in time this year unless some stuff happens that's completely unexpected and just completely changes the psychology of the market. All right, let's go look at some breadth readings. We'll flip through them semi-quickly. So it's the S&P 500 versus the cumulative AD line. They match up pretty well. High here, low here, low here, high here, high here. So since they match up pretty nicely, it pays to pay attention here. We had a high here, and then this moved up and this moved sideways. So that kind of kept the market in check. This is during this period is where it really became a stock picker's market where a rising tide wasn't raising all ships. A lot of stocks were just sitting tight, and there were a small number of stocks moving up. As long as you were in those stocks, you were doing great. If you weren't in those stocks, then you were wondering what all the hoopla was about. Then all at once, we got this big breakout last week. Not last week, but in the last couple weeks, you can see move to a new high, market move to a new high. These curves remain in sync. Everything looks good. Okay, like you could doubt it. There's a little bit of a wall of worry out there, but the reality is the market's strong, it's healthy, it's trending up, and now in the AD line is just printed a new high. So can't really argue with that too much. It's not a perfect indicator. Okay, because if Apple moves up and some other small company moves down, this indicator, those two would cancel each other out. And obviously Apple's a lot more important than some small little insignificant company. So it's not a perfect indicator. But, when you look at this and see how the lows and the highs match up, it's kind of hard to ignore. So it's a good sign that we just recently made a new high over here with the 80 line. Anything goes day to day or week to week, but overall I would say, the market's in good shape and we should maintain our up bias in the long term. Here is same curve except it's cumulative AD volume line. This also is not a perfect indicator because sometimes you got some small stocks that trade 25 million shares, then you got a large stock that only trades, that's expensive and therefore only trades like 5 million shares. So not a perfect indicator, but it's still pretty good. You get a breakout here and the market moves up, and you get a breakout here and the market continues up, and then you get a breakout here and the market continues up. So kind of hard to ignore the fact that it's been trending up since last October. We just printed a new high, so it confirms the market strength. Again, anything goes day to day or week to week, but the long-term backdrop is very positive. All right, here's Russell 3000 stocks above their 20-day moving average. You can see over here that for, market was going up, printing, all-time highs almost, like not every day, but like every other day, certainly every week. And the number of stocks trading above their 20-day moving average just kind of sat tight in a range underneath 50%. So you had less than 50% of stocks were even above their 20. The 20 isn't really a high bar to get over. You don't have to be that strong to get over your 20. But yet more stocks were below their 20 than above. And then all of a sudden, boom, we got a huge spike up here to like 90%, which was the highest print we've had, going back at least a year. So market was very subdued, lots of stocks being held back, and then all of a sudden, all at once, we jumped from 50% to 90%. So suddenly, a lot of smaller companies were being held back, and then suddenly they started participating. Situation with the 50 is the same. This is Russell 3000 stocks above their 50-day moving average. For several weeks, it was not only under 50%, it was down near 40%. So you had market going up, but you had a lot more stocks, not a lot more, but you had more stocks trading below their 50 than above their 50, and then suddenly it jumps all the way to 80%, which is a nice solid print. Okay, so the internals were weak, and then suddenly they surged and were on board with the overall market. All right, this is the S&P 500 versus the 1 month high low. So you can see here, all through here. Oops, that's not what I wanted. You can see out for 5-6 weeks here, you had more stocks at a 1 month low than a 1 month high, even though the market was moving up. So that tells you there's a lot of stocks being left behind. Participation was thin. You use whatever analogy you want. Bottom line was there were a smaller number of stocks moving up, which were controlling the indexes, and a lot of smaller companies being left behind. And then all at once we get a breakout, and boom, we get a spike up to 2,000, which is nearly matched the spike from here. So participation was not very good, and then suddenly it was really good. As a couple thousand stocks printed a 1 month high. So internals were weak, and then suddenly they're very strong. Here's the all stocks 52-week high low. Situation was the same. You can see here's the zero line. So even though the market was going up, you had more stocks at 52-week lows than 52-week highs. I mean, 52-week lows is hard, because the market put in a low like way over here in October, November. We're like 9 months off the low. The S&P, you can see over here, the S&P was like 4,100, 4,000. Down here in the low 4,000s, now it's like 5,500, 5,600. So the S&P is up like 1,500 points in 9 months, and yet you had more stocks printing 52-week lows than 52-week highs. Okay, so it's a huge negative divergence, and then all of a sudden it just surged to plus over 500, which is a new high. So participation was weak, and then it was really strong. All right, so that's the situation right now. The S&P, NASDAQ trending up, strong, healthy. Everything looks good there. We can get a dip down to the 21 moving averages on the weekly time frame. That'd be perfectly fine, and it wouldn't destroy anything it wouldn't destroy like the backdrop. Small caps neutral overall because they're unchanged going back several years, but in the near term they just broke out of a range, and it's inevitable that they're going to go to their high. I don't know if it'll happen now or like later on this year, but it's going to happen. And then with all the indicators, all of them were being held in check. The market was going up, but the market was thin. Okay, internals were weak. Not very many stocks. The advanced decline line was flat. Number of stocks trading above key moving averages was flat and like oftentimes under 50%. The high-low on various look-back periods was was under zero, meaning more stocks were making 52-week lows and 52-week highs, or 1 month lows versus 1 month highs. So market was moving up because the big caps which control the indexes were doing great, but beneath the surface, the situation was pretty thin. Participation was weak, and then all of a sudden, the small caps surged, the mid caps surged, and suddenly breadth went from being weak to being strong. So now everything's on board. For a couple months, we moved up with a wall of worry, but now that wall of worry has been shattered to pieces. Okay, so overall, market's strong, it's healthy, it's trending up. We want to maintain our bullish bias, but be a little weary of the fact that like once everything gets on board, then what's the next group to grab the baton and lead? Okay, so I'm bullish overall, and I think we got to maintain our bullish bias. I have a lot of confidence the market's going to be higher at the end of the year than it is right now. Things could happen in with politics and such, but overall market's doing well, and we should maintain our bullish bias and and keep trading the long side. All right, hope you got something out of this, and I'll see you next time.